So I was recently asked a question by somebody who was looking at equipment, and they were asking, how does a lease versus buying equipment affect your financial statements? When you look at leasing equipment, there are two types of leases. There is one lease that's called a capital lease. This basically is a financing mechanism for that piece of equipment. So typically, if you're going to own the equipment and have to pay very little for it, you'll treat it just like a fixed asset. It'll go on your balance sheet, and the amount that you will owe will show up as a note payable. That's a capital lease. The other type of lease is an operating lease. With an operating lease, you take rent expense rather than depreciation to expense the piece of equipment. The nice thing about a capital lease is you can normally take bonus depreciation and expense it all in 1 year, where an operating lease, say a car lease for example, you typically are just paying it every month and taking the expense for that period of time. The other alternative is just to buy the equipment. When you buy the equipment, it goes onto your balance sheet and then you take depreciation. Typically, most of the time, we're writing it off in the year that you buy it. If you have any questions or comments, please feel free to reach out to questions@mydentalcpa.com.